Hello traders and welcome to another episode. And in today's episode, you're going to look at the ICT order blocks. That is how to identify high probability ICT order blocks. Remember, not all order blocks are high probability. So what you need to understand about order blocks is that in trading, order blocks, or what is referred to as OBs, these are key price levels that represent areas of high probability for market reversals or continuation. So with ICT methodology, which is developed by Michael Andalston, it is widely followed for identifying these levels. So remember, I attribute this concept to the original author of ICT, Michael Andalston. So it is not my concept. What I've done is I've just tried to simplify some few things and also increasing the confluence, adding some confluences so as to increase the probability. So what I'll be doing in this video, I'll guide you through identifying and trading high probability ICT order blocks and showing you with chart examples. So let's begin by looking at the definition of an order block, or what is an ICT order block. So an order block is essentially a range of price levels where large institutional orders have been executed and price shows signs of reacting to these levels in the future. So these areas are zones for potential reversals or continuation moves. Typically, order blocks occur at the open and close of candles within a range, either bullish or bearish, and where institutional traders enter positions. Thus, we will have two types of order blocks. That is the bullish order block and the bearish order block. So what we are trying to say here is that in a layman's language, or in an easier language for you to understand, order blocks are candlesticks where the market makers, and when we mention the market makers, I'm talking about the banks, have placed their positions. And in these areas, the market returns to these candles and they are never violated if they are really order blocks, all right? Or if they are real order blocks. So that tells you, or that echoes the point that I said, not all order blocks are high probability. So what is the characteristics of high probability order block? So the first characteristics, we have at least four characteristics, and I'm going to take you through step by step. So the first characteristic of a high probability order block, you need to check clear market structure. So an order block usually forms after a significant swing high or swing low, indicating a strong directional bias. So look for clear higher highs and higher lows in bullish trends and lower lows and lower highs in bearish trends. So once you have identified a clear market structure, then look at the last bullish or bearish candle before strong moves. So the key identifying feature is that the last bullish candle before a bearish move, or the last bearish candle before a bullish move. And these are called bullish or bearish order blocks. So the last bullish candle before a bearish move, that is what you're calling a bearish order block. And the last bearish candle before a bullish move, that is what you're calling a bullish order block. So the third step, after identifying the order block, the third step after identifying the order block, look at the institutional sponsorship. What am I talking about institutional sponsorship? Order blocks represent areas where institutions accumulate or distribute large positions, often creating a strong move after the block is formed. So identify where these smart money traders trades occur. Identifying where these smart money trades occur can provide clues for entry points. So how are you going to look at the institutional sponsorship? So once you identify your order block, we want to see an abrupt move of prices or an impulsive move of price from that order block. And this will signify that these are levels or areas where institutional accumulates or distributes large positions. Then number four, look at the break of structure, what we call the BOS, or what we call the break of market structure, BMS. So a strong confirmation for an order block is a break of structure. So there has to be a break of structure. So when price returns to the order block after a break of structure, it can often act as support or resistance, meaning that the price is likely to react from that particular level. So those are the four characteristics of high probability order block. Number one, clear market structure. So you need to identify a clear market structure. Number two, identify the last bullish or bearish candle before strong moves. And number three, look at the institutional sponsorship. And number four, break of structure. Then, how to identify a high probability order block. Now we are going to implement, to look at how we are able to identify these high probability order blocks in line or in conjunction with the characteristics that we have looked of a high probability order block. So the first step that we need to do is to identify the market structure. So the market structure here is very significant. So start by defining, right? Start by determining the prevailing market trend. So whether it's a bullish trend or it's a bearish trend or it's a consolidation market, because those are the three states or the three phases of a market. So if the market is trending, so for us to identify the order block, the market has to be trending. So for us to have a high probability order block, right? So in a consolidating market, it can be tricky to identify a high probability order block. So if the market is trending upwards, then look for higher highs and higher lows. And if it is trending downwards, look for lower lows and lower highs. Another significant aspect, if you're not in a position at all to identify to be able to identify the higher highs and higher lows, then look at an instance where the market is creating the BOS or the BMS on the upside. That is when the market is taking out the previous highs or the swing highs and respecting the swing lows. That is an uptrend market. For a downtrend market, if you're not able to identify a series of lower highs and lower lows, then look at a condition where the market is creating BOS or BMS on the downside. That is in a situation where the market is creating is taking out the swing lows, but respecting the swing highs. Then number two, locate the order block. Very important. So look at the last bearish candle in an uptrend. That is a bullish OB or bullish order block, or the last bullish candle in a downtrend, and that forms the bearish order block before a strong price movement. All right. So we have to identify these order blocks before a strong price movement or before we have what we call institutional sponsorship. So this represents the institutional activity. Then number three, confirm break of structure. So a break of structure or BOS happens when the price moves past a recent significant high or low, indicating a change in trend. And once this happens, price often retraces back to the order block for confirmation. So this is what I'm talking about. As you can see, this is a market, all right? So this is a market. So from this market, as you can see, it is creating series of lower lows and lower highs, all right? So, and this is the last bullish candle before the downtrend. And this is where the BOS actually happened from this daily time frame. You can see this is the swing low, this is the swing high, and this is where the BOS happened. So we have the BOS, that break of structure here. Then number two, we can identify the market structure. The market is creating series of lower lows and lower highs, so it's in a downtrend. And then we mark or we identify the order block, and that is the last bullish candle. In this kind of a scenario, this is the last bullish candle, and we mark that as our order block. Then number four, mark the area of the order block like I've shown you there. So I have identified this last candle and I've been able to mark that area and also labeled it bearish order block. So I highlight the range of the order block, focusing on the open and close of the candle as well as any wicks. So like you can see in this candle, the last bullish candle before the downtrend, I have marked from week to week. All right, you can see I've marked from week to week. That's how we mark the order block, from week to week. All right. Then number 5, we need to wait for retest. And now we enter the trade. So once the price revisits the order block area, look for confirmations like candlesticks patterns, e.g. pin bars, engulfing candlesticks. I've been able to do videos on these types of candlesticks. So you can check previous videos. All other ICT concepts like fair value gaps, that is the FVG for entries. You can also use the Fibonacci retracement. I've also been able to show you how to use both the normal Fibonacci and the ICT Fibonacci. So this is now what you're talking about. So after identifying now this last buy candle before the downtrend, now we have to wait for the price. So we have to be patient. Remember, Forex trading is a game of patience. So we have to be patient and wait for the price to come back to this level or to retest. That is our rule number 5 in terms of identifying a high probability order block. Wait for retest and then now you enter, right? So once you wait for the retest, then now the price comes back to this area of the order block, you take your trade, right? You take your trade. So this is a bullish order block. All right, as you can see, this is the last sell candle before the bullish momentum. We already have the break of structure here. All right, we already have the break of structure here. So the price comes again now to retest the order block. After break of structure, the price comes to retest the order block. And this is where you have your entry. And once you take your entry, then you can use different ways to take your profit. Maybe you can use risk to reward ratio of 1:2. You can use the liquidity levels, maybe have TP1 here where we have this liquidity, and then target TP2 where we have this other liquidity. Or maybe you can use bearish engulfings. Now that you have taken a bullish order block trade, so you exit once you have a bearish order block, right? So whichever strategy you use to take your profits, but it has to be a well-defined strategy, right? So, uh, in a nutshell, trying to simplify what you have said, in a bullish order block, for a bullish order block, so we want to look at an uptrend. So in an uptrend, the last bearish candle before a sharp upward movement can be considered as a bullish order block. So traders expect the price to revisit this order block before continuing upward. So steps to identify, of course, I've said number 1, market structure. So for a bullish order block, we want to see market structure, an upward trend, that is series of higher highs and higher lows, or a situation where the market is taking out the swing highs and respecting the swing lows. Then number 2, look for the last bearish candle before an upward push and mark that area. Then wait for the price, wait for a break of structure. So creating new highs and anticipate price retesting the order block. Then enter on confirmation when price reacts positively to the order block, like you can see in this case. So we have price impulsive move of the price, we have the break of structure, we have the market coming to retest this, and this order block we have marked it using the last bearish candle before the upward trend. So this creates the bullish order block, right? So for a bearish order block, just trying to simplify or to summarize what we have talked about. So this must be gotten in a downtrend, all right? We must identify, or a bearish order block often occurs in a downtrend market. And in a downtrend market, the last bullish candle before a sharp downward move of price can be considered as a bearish order block. So steps to identify: You confirm the market structure, that is lower lows and lower highs for a downtrend, or a situation whereby the market is taking out the swing lows and respecting the swing highs. Then number two, locate the order block, locate the last bullish candle before the sharp price move. Then number three, confirm the break of structure. So watch for a break of structure to the downside, that is lower low. Then number four, you need to mark the order block. All right, you need to mark the order block. And once you mark the order block area, then enter a short trade when the price revisits and rejects the order block. So this is what we are talking about, a bearish order block. So we have an impulsive move of the price. So first of all, we have an impulsive move of the price from this level. Then this is where we have the BOS taking place, all right, the break of structure. So we have series of lower lows and lower highs, so a downtrend. And then the last bullish candle before the bearish momentum. And then now, once we mark that as our bearish order block, we wait for the price to come and retest that, and we take our trade. So, what is the entry strategy? So, you can have different entry strategies, all right? You can have different entry strategies. So you can have what you're calling an aggressive entry. So this is where you enter as soon as the price taps the order block zone and is expecting a quick reversal, all right? So the moment the price taps the zone of the order block, you take a trade. So if it's a bullish order block, you take a buy trade. If it's a bearish order block, you take a sell trade. Then we have the conservative entry. So for the conservative entry, you wait for confirmation such as a bullish or bearish candlestick pattern forming inside the order block zone. So e.g. engulfing patterns or pin bars, because these are candlesticks patterns that show rejection. So what you want to be sure of, you want to confirm that indeed there is a rejection from that area. So you can confirm that using these candlesticks patterns, the pin bars, the engulfing patterns, and also the dojis, right? Then number three, you use what we call multi-time frame confirmation. So you check higher time frames like 1 hour, 4 hour daily to align your order block trades with the bigger trade, adding a layer of confluence, right? So this is where you want to confirm, or where we say the trend is your friend. So if you are trading this order block, so you have to check the higher time frames and align your order blocks, all right, or your order block trades with the bigger trend, adding a layer of confluence. So if the bigger trend says it's a bullish trend, and maybe you are trading from a lower time frame that the order block shows you it's a bearish order block, then you might want to not really concentrate on that, but you might want to make sure that if you are trading a bullish order block, then even the higher time frames aligns with a bullish trend. All right. If you're trading a bearish order block in the lower time frames, you want to make sure that the higher time frames, the trend is aligning with your order block. All right. So which is very significant. So stop loss and take profit. So how do you put your stop loss and take profit? So for the stop loss, you place below the low of the bullish order block or above the high of the bearish order block. For the take profit, you can use the recent swing highs or swing lows or Fibonacci extensions to determine the targets. So like I've shown you here in this scenario, so for this one, you will have your stop loss slightly below the order block level. And then for taking profits, you can use the swing highs, you can use maybe the Fibonacci extensions to determine your exits, or maybe probably you can use maybe risk to reward ratio of 1:2, right? So you can see here, so with this one, we are putting our stop loss slightly above because after marking the last bearish candle, what we have here, all right, what we have here after marking this candle, what we have here is this candle had a wick, all right? The bearish candle here had a wick. So we will put our stop loss slightly above the wick of that candle. And now for taking profits, you can use the swing lows, all right? Because these are bearish order block, you can use the swing lows, or maybe probably you can use maybe where we have the bearish order block, because around this level we have a bearish order block, or maybe probably you can use risk to reward ratio of 1:2. But I said whichever strategy you use, it has to be a well-defined strategy. So the same case here, stop loss needs to be for the bullish order block, the stop loss needs to be below. Then we have the prices pushing higher, so you can use the swing highs as your take profit levels, or the Fibonacci extension levels as your target, as your exit target, or maybe risk to reward ratio of 1:2, 1:3, etc., etc., as you deem fit, right? So that's about the order block. So what I'm going to do next is I'm going to take you to the charts and show you how I identify them, these order blocks, high probability order blocks in the chart. So let's go to the charts. So this is the charts, GBP USD. So we are going to begin by looking at, we will look at both how to identify bullish order block, high probability bullish order block, and high probability bearish order block. So we will be guided by our four characteristics of a high probability order block. Remember, we talked about clear market structure. We talked about marking the last bullish or bearish candle before a strong move. We talked about looking at institutional sponsorship. We also talked about looking at the break of structure, right? So the first step that we are going to use, if you look at this particular level here, the market initially was in an uptrend. Then in an uptrend, this is where we have the lower, I mean the high low, right? This is where we have the high low. And one of the ways to know that the trend has changed, you look at where we have the change of character, all right? So the change of character here now shows that the market has reversed. So the change of character, sometimes you can also refer to it as BOS, all right? So it's a change of character, but it also acts as a BOS because the market has taken out the previous swing low, all right? Or it has taken out a swing low. So then here you can see the impulsive move of price, all right? You can see these strong sell candles, all right? They are impulsive move of price on the downside. So meaning that this is an area where institutions accumulate or distribute large positions, all right? And the reason why now we're interested in marking the last bullish candle, all right? We are going to mark the last bullish candle. So this is the last bullish candle. So the last bullish candle before the up movement, all right? Before the down movement. So we mark that, all right? And this is what we are going to call our bearish order block. So this is our bearish order block. Bearish order block, which usually maybe you can rate it minus OB, meaning bearish order block, right? So with this bearish order block now, after we locate, so we have located the bearish order block using all the confirmation. We have the break of structure. We have a clear market structure, all right? So right now we have to wait for the price to come and retest this level, right? The price to come and retest this level. And when the price comes to retest this level, we can have the aggressive, right? The aggressive way of entry. It's when we take a position immediately when the price comes back to the comes into this level, we take our position, all right? So remember we said we are going to target swing lows. So maybe probably we can target the swing lows here. So we can target these swing lows. All right, so we can have that one as our TP. So this is how the setup will look like. So that is the TP. Then we have our stop loss. So how are we going to put our stop loss here? So it will be slightly above the order block level. All right, so slightly above that order block level, maybe 10 pips, 20 pips from that zone, all right, somewhere there. So, and you can see this is a setup that is giving a risk to reward ratio of 1:2. 2.36, right? And again, this is the daily time frame, so this is quite some good number of pips there. So that's how you set your stop loss. That's how you look at how to set your TPs. And also that's how to identify. So after marking, so the first thing is to identify the structure. So we have identified it's a downtrend because we have a break of structure or we have a change of character from this uptrend trend. So we have that change of character. So also you can see the impassive move of price, what we are calling institutional sponsorship, meaning that we have institutions accumulate or distribute large positions around this level. And then now we mark the last bullish candle before the bearish momentum. So that is locating the order block. So then now we wait. After we locate the order block and mark it, we wait for the price to come and retest that. So that is how you can have an aggressive entry here, or maybe probably within the order block, you can look at maybe rejection candlesticks like the engulfing. So around this particular level, you can see we have an engulfing here, right? So we have this buy candle and the large sell candle are bearish engulfing, also signifying lower prices. So meaning that you can also take a trade now once the price comes to retest that. So you can maybe probably have your short entry around that particular point when the price comes to retest. So this actually increases even it increases your stop loss needs to be above the high of that candle that formed the engulfing, and this actually even increases your reward. The risk to reward ratio of 1 is to 4.95. So those are two ways that you can be able to trade from these bearish engulfing. So let's look at an example of an example of a bullish order block. So this is now we are going to look at the bullish order block. So as you can see, this market was trending on the downside. So this is where we have major highs, right? This is where we have major highs there. So that is where we have a change of character, or what we can call the break of structure, right? So change of character signifying now we have a change of trend from downtrend to uptrend, right? But it's also a BOS because the price is taking out it's taking out the swing highs, right? So then here we can see the price moving up. So we have the impassive move of the price. All right. You can see the momentum of these buy candles also here. So then after that, what we need to do is after identifying the structure, now we are identifying we're in an uptrend. So we need to to locate the order block. So we mark the last buy candle. So as you can see, the last sell candle before the bullish momentum. So these are our last sell candle, which is a doji, all right, which is a doji. So we can mark that like that. So yes, like that. So and then now we have this candle here, create a wick, all right? So how to handle this? This is a very special case. I think you can follow me keenly here. So what we are looking at this particular point, we are considering this now being our order block, all right? So this is the order block level. So this is what we are calling the bullish order block. So I can write it plus OB. So here, what we need to do now is to wait for the price to come and retest. Notice this scenario, when the price comes near this level, it did not retest. So again, you need to be in a position not to be able to rush your entries. So you wait for the price to confirm 100% your strategy. So you wait for the price to come back to this level. As you can see, the price came back to this level. And this is how now you have your entry, right? This is how you have your entry. Number one, you take the moment the price taps there, that's where you have your entry. But now in setting the stop loss, you need to consider the low of this candle, right? You need to consider the low of that candle. Because like you can see in this scenario, the price took out the liquidities there. We had some liquidity grab. So you put your stop loss slightly below the low of this candle that is in the order block level, all right? Or in another way, you can just maybe probably pull all that like that. You mark the entire of that, right? But that might confuse you. So the best thing is to mark the order block itself. There you locate the order block. Then now identify the liquidity here. So you put your stop loss slightly below the liquidity level. And then now you can use the swing highs in terms of taking your profits. So you can consider maybe probably taking your profits here, right? Using this swing high, we have the swing high there. So you can target there as your take profit. And as you can see, the price was able to come and hit your take profit. But again, it's good also to have what we call partial profits, all right? So maybe around this level as well, you can have your partial profit around that particular point. So this is a risk to reward ratio of 1 is to 5.67. So you can decide even to take partials when the price gives you half of your target. All right. You take partials and you put your stop loss at break even. All right. So that's another way. That's a way of you can be able to take that trade. So another way to look at it, if you look at some brokers, you might realize that this is a buy candle. All right. This you're seeing the doji here is a buy candle. So we might regard these as being our sell candle, all right? That is our last sell candle. So you mark from week to week, all right? So if you use that as well, so depending on how it will appear in your broker, so here we have the price pushing higher. So like I said, this is where we have the change of structure, all right? So the BOS, that is where we have the BOS. Okay, that is where we have the BOS. So that tells you this is not an entry. Why? Because the price had not taken out the BOS here, but it is this push that pushed the price, this move that pushed the price to take out the BOS. So the moment now we have the BOS, you wait for the price to retrace, right? You wait for the price to retrace now to your order block level that you have located. So as you can see here, the price retraced to that level, and then now we see the move. So this is where your entry is. So this is where you're able to take your entry. So you have that, and you have your stop loss slightly below that particular week, right? Slightly below the week. You're considering this week here. So you have your stop loss low slightly below that week. And then now maybe probably you can target the liquidity levels here. All right, you can target the liquidity levels here. Or you can use any other strategy. Maybe you can use these engulfing here to take your profits, all right? This level. So that's an engulfing. You can use it to take your profit. So whichever way you use, I said the strategy of taking profit and putting stop loss, it has to be a concrete strategy, a predefined strategy, a strategy that you have been able to back test and see that it works. All right. So this is a nice setup for these bullish order block, right? So for this bullish order block. So that's how you do it, right? That's how you mark them. That's how you're able to identify them. And it becomes quite simple in terms of identifying these order blocks. So the moment you understand them, it becomes easier for you to be able to treat them. But what I can promise you is that whichever the strategy that you're using, note that it will not happen each and every day in the market. So there'll be some days that the market will not formulate your strategy. So in those days, you need to be patient. And especially if you're trading one asset only. So that tells you that you might not get entries using that strategy each and every day, right? So that's it. So until next, keep safe and keep practicing, keep revising, because practice is what makes perfect. So if you liked this video, if it was informative to you, so like, share, comment, and I'll be able to address any questions that you have in the comment section. So thank you so much, and take care.